Today on Lewis on the Law, I have attorney Lucy Zhang in the studio with me, and we are talking international tax law. You guys get excited, be ready to have your shoes blown off as we get into the nuts and bolts of how to make your business profitable facing this new tax regime. You are listening to Lewis on the Law. My name is James Lewis, and I have an awesome show for you today, and really exciting. I can't hold my excitement. It's on international tax law, and I'm really honored to have Lucy Zhang in the studio with me, attorney Lucy Zhang, and she is a specialist in international tax law. Lucy, I actually know Lucy from the tax clinic. We both served some time way back then, and everybody else I was in the tax clinic with, they're all doing tax law now. I'm the only one who's reading commercial leases for a living.
You seem to enjoy those, so can't say anything.
Yeah. They pay me to basically just read 200-page, really boring documents that nobody else wants to read, and then tell them what it actually says.
Sounds like my job too. A couple hundreds of regulations here and there, so same boat.
Yeah. And it actually beats what I used to do, because I used to read statutes and codes and ordinances for a living and then tell a corporation exactly how to build their infrastructure. So
welcome to my life. That's exactly what I do.
I know, right? Reading stuff that no one else wants to read. So today's topic is international tax law. And Lucy, I know you used to do federal tax controversies, and then you transitioned to international tax planning and structuring, right?
Yes, that is correct.
So how did that go?
I wanted to learn more numbers. Wanted a challenging experience and fought for it, hustled my way through it.
Yeah, there's nothing more challenging than international tax law. It boggles my mind. Okay, so let's start here. What do we start? I mean, this show is on business radio. A lot of our listeners are small business owners. Maybe some of them will go into some sort of international commerce. What kind of things are we talking about here?
So we're just talking about commercial tax law. And because my focus is on international tax, it's really interesting in seeing different types of companies expand internationally. And this is a great time to expand internationally given the new tax regime. We'll touch upon that a little later, since there are quite a few acronyms that we are forced to learn now given our wonderful tax reform law. Quite a few hundreds of pages, maybe even thousands of pages of regulations that have been released, but then also a couple thousand more that are on the way. So hopefully this will be helpful to small business owners as well, since, hey, international market is a great way to expand.
It is a great way to expand, and there's lots of incentives for people who go into international business that they might not actually realize that are there. We're not going to get into that on today's show. I think I had another guest a while ago talking about actually investment platforms for people outside the country to invest inside the country. And there's also platforms for people to invest inside the country to invest outside of the country too, especially in the export arena. But that's way beyond the scope of what we're doing here today. So let's talk about this, the worldwide tax system. We had lunch about a couple of months ago, and you know what Lucy said to me? She said, "This is an exciting time to be a tax attorney." I'm just like, and most of the people out there listening, they're like, what?
Well, most people go to law school because they can't do math. So I'm one of the few who actually enjoys the numbers. So it's a great time to be in there right now, and a lot to learn. Especially with all of the things that are going on with tax reform, it is the best time to be in tax because so much to learn. Everyone's starting at the same playing field, regardless of how many years you've been practicing. So it's a great time for someone like me to jump into the game.
That's right, because there's a new tax system. So is there some sort of worldwide tax system? Is that the way it works? Is there actually a worldwide tax system?
Yes. So before tax reform, there was actually a worldwide tax regime. So say a company has a foreign subsidiary in China. All of their income is subject to U.S. taxation and China local tax as well. So they're subject to double taxation. But now that has changed, and because of the whole worldwide system, there were different types of planning structures that companies would use, similar to saying, well, hey, we're making $100 million in China, but we are actually planning on reinvesting all of those earnings in China. That means you get to evade taxes, avoid paying taxes on those $100 million worth of earnings. And so that was something that a lot of companies used to their own benefits. let's just say Facebook. They've had quite a few articles of how much money they've earned in Ireland and how much money they've kept on Ireland. It was a couple $1 billion where they left offshore in Ireland and never paid taxes on. And that was part of the previous worldwide tax regime.
So let me get this straight. So if countries were earning capital in another country, they wouldn't have to pay taxes here in the United States.
If they prove and say that they are permanently reinvesting those foreign earnings offshore.
Okay. So now how has that changed?
So the tax reform has changed it completely. Tax reform, they say that this new system is going to be simpler with the intent of moving from that worldwide system to a territorial system, saying that there is going to be 100% dividend reduction. So say that Chinese subsidiary paid $50 million worth of dividends to the U.S. In the old regime, that $50 million is subject to U.S. taxation. But now with the new regime, that $50 million, even though it is, quote, subject to tax, but it receives 100% dividend reduction rate. So you basically don't have to pay taxes on that particular dividend. But there's a catch.
There's always a catch, isn't there?
Of course. They say that's going to be simpler, but has become much more complex these days because of the fact that they are now taxing foreign subsidiary earnings in a different way. And that may
Okay, so wait a minute.
confuse.
Foreign subsidiary earnings. Let's define that. Let's go backwards a step and let's break that down. What is a foreign subsidiary earning?
So let's say
What is earnings by foreign subsidiaries?
Sounds good. We can definitely start from the
Mhm.
beginning. So
Mhm.
not to confuse everyone, right?
Mm-hmm.
So let's say if U.S. parent company, say you own a company in the U.S.
Mhm.
and you decide to open another corporation under your parent company in China, just continuing with that particular country.
And that's good to know because lots of people do that. I mean, I did that with my own company. I opened up several smaller companies within an umbrella.
Exactly.
So that's helpful. You can do that internationally,
Of course.
and that becomes a foreign subsidiary.
It does. That's
Okay.
exactly what happens. And so that a lot of times companies will create these foreign subsidiaries to take advantage of local taxes or potential local resources. And so, but another way to benefit it, besides thinking of the business and marketing strategies, is how can you use the tax laws to your own benefit instead of your detriment? So, say you opened another small company in China and you wanted to take advantage of their resources there. So now with the tax reform, say you were just start manufacturing products, every single time you sell a product, that's income, and that's subject to Chinese tax. And now instead of having that exact U.S. tax, it's subject to what is called it's subject to GILTI, and that's
Mhm.
going to be the global intangible low tax income because it's under that new regime. So even though they say that it's not subject to tax, it is still somewhat subject to taxation. And so that's what causes that now. The new tax regime now is considered a hybrid, quasi worldwide tax system, which makes it just a little more difficult and complicated than it was before.
Okay, so simplify that a little bit. So what's really happening there when you have a foreign subsidiary? Now you're paying taxes in the foreign country, and then you're paying a reduced amount of taxes here in the United States.
Yes. So you were always paying taxes in the foreign country.
Mm-hmm.
That
That
has
hasn't
not changed.
changed. Uh-huh.
But the way that the U.S. looks at this foreign income has changed. Previously, it was just subject to tax, just subject to potential, like let's call it, since you own it 100%, it would be called a controlled foreign corporation. So every single earning and income that you have on that, you are subject to 100% U.S. taxation, which used to be around 35+%. And now, because of the whole new regime, it's not subject to the U.S. corporate income tax rate, which is now at 21%. Instead, you have to go through this completely crazy mathematical equation to calculate, well, what is your income? And then they give you some deductions, give you some taxation rates, and it comes out to be around 10%. of taxation
Okay.
from a U.S. standpoint.
Well, that's a great tax rate. My personal tax rate's higher than that. So it seems like this new tax law is really impacting businesses all over. I mean, my latest contract I'm working on is actually getting commercial leases and commercial assets ready for the Form 842 so they can be taxed in a different way. And so it's amazing the way this new tax structure is impacting every area of law, and people probably don't even think about that. Okay, when we get back, we're going to get into a lot of stuff. We're going to get into pre-tax, what it was like in the pre-tax era, and what it is like as a post-tax reform era. Yes. You're listening to Lewis on the Law. My name is James Lewis. I'm here in the studio with attorney Lucy Zhang. I keep pronouncing your last name wrong.
Of course.
I think I've been in the South for too long. We'll be back in a minute, right after these messages. You are listening to Lewis on the Law. My name is James Lewis, and this show is all about empowerment. My show is not designed to replace the advice of an attorney. If you have a serious legal issue, you need to go ahead and contract with an attorney. This show is just designed to be a first step in the process. I have all my shows archived on my website. You can go to my website, jameslewislegal.com, and you can check out your issue. If you don't find your issue there and you need to talk to someone, go ahead and contact me, and I may be able to help you with your problem. If I can't help you with your problem, I can direct you to an attorney who can help you with your problem. So go to jameslewislegal.com. You can email me at jameslewislegal, or you can give me a call at 404-610-0075. I have a super exciting show for you today because, as Lucy told me once personally, it's a really exciting time to be a tax attorney. Okay, so right now we're talking about international tax law, and we were going into when we left last, we were talking about the pre-tax reform environment. So what were the planning issues in the pre-tax reform environment?
How to decrease taxes, the effective tax rate.
That's everybody's ball game, right?
Of course, and there were so many easier ways to go about it. Let's say if someone had an intellectual property, it was really easy to move that offshore to Ireland and essentially pay 0% on those earnings from those intellectual property, which I'll start calling it as IP to make it easier for myself to say.
Yeah, I think it's easier for everyone to say just IP. So wait a minute, they're paying zero taxes if they move IP into Ireland? How does that work?
So it's actually just a play on tax regimes. So in one way is thinking of, we mentioned earlier, is making sure that you permanently reinvest those earnings from Ireland in Ireland. And Ireland has this great regime where, Ireland did have this great regime where all of this IP earnings is subject to an extremely low percentage rate of taxes. So a lot of companies would target Ireland to put and move all of their IP from the U.S. offshores. So that way their effective tax rate for those particular earnings was extremely lower than what other businesses would actually pay. So this was just one thing that companies would definitely take advantage of.
Okay, that sounds sensible. So wait a minute. So if countries have their IP in Ireland, but they're actually earning money in other countries, that doesn't actually help them escape that taxation, does it?
It can actually, because say Ireland ends up owning different companies, and so it's just part of those the structure of the organization. Say you own a company, and then you form an entity in Ireland, and then Ireland ends up holding different companies, then the earnings flow up to Ireland. And if you hold all those earnings in Ireland, then you're pretty good.
Oh, okay. So, that sounds like a pretty big loophole. And so has it been closed completely?
It has not been closed completely, but I will say not only is the U.S. changing its tax regimes, there are quite a few different countries that are changing their tax regimes out as well. That will be probably for another day, since there are so many different things going on in Ireland, UK with Brexit. But those are definitely things that we consider when we are thinking about moving certain things offshore or moving things back and repatriating it domestically.
Okay. So now, what are the consequences in this post-tax reform world?
Well, one thing that has the most dramatic impact is this one-time transition tax. say that those companies who continuously kept their foreign earnings offshore, they are now subject to this one-time transition tax, which is a toll charge, forcing you, even just deeming the fact that you're bringing all of those foreign earnings back to the U.S., and that is subject to a 15.5% rate on cash and cash equivalents or 8% on other types of assets. So let's just say some companies have earned millions of dollars offshores. All of a sudden now they're subject to this one-time tax, and it could be a drastic increase in their tax expenses. I actually pulled up some numbers from different financial reportings, and let's just say the top 3 headquartered companies in Atlanta. Home Depot, they were subject to $300 million worth of taxes just for this particular bucket of transition tax. UPS was subject to, I think, approximately $330 million, and Coca-Cola was subject to $4.6 billion of taxes just for this one category. And so now companies need to figure out, well, how are they going to account for and pay for these taxes, because it's this one-time tax that no one planned for. Luckily, you have 8 years to pay for it, but you still have to pay for it.
Yeah, because one of the hurdles, and just as a small business owner, I know that I need to have a certain amount of predictability in finance, or it's hard to move forward with any amount of confidence. You don't know how to schedule your rate, what kind of income you need to actually cross that monthly hurdle or yearly hurdle as it may be for some of the bigger corporations. But so what is the impetus behind this tax charge? I mean, it doesn't sound very business friendly.
It does not, but the intent behind this was to bring money back to the U.S., to repatriate all of these foreign earnings. I believe the congressional intent was to bring this money back so that there would be additional expansion and business development within the U.S.
So it's a disincentive for companies to use their money outside the United States.
Well, actually, I think of it more as a penalty for companies who took advantage of those loopholes of permanently reinvesting money offshores, because this is relating to earnings in the past. And so it's become a difficulty conversation with clients, because they have to track these earnings as far as 1986, which sometimes, if you have good books and records, easy enough. But at the same time, if you're a larger company with hundreds of subsidiaries and multiple transactions have occurred over the past 20, 30 years, it's really difficult to actually say, well, this is how much we really owe to the IRS.
Now, wait a minute. They're going to have to go back to 1986?
Yes.
Now, why is that?
So with the 1986 was the last change in tax regime. And so before 1986, there was something called the pre-1987 earnings and profits. And that is something that we are not going to consider. So for companies who are much older than 1986, those earnings are fair game. But after the 1986 change in tax regime, this is now considered a new type of bucket of foreign earnings and profits. And this is the amount of money of foreign earnings that the IRS is currently subjecting to this transition tax. And that's why it's from 1986.
That huge bucket of money from 1986 is all going to be subject to this transition tax?
If you have not brought it back, repatriated in the past and paid U.S. tax on, yes, all of it. Wow,
that seems like a huge penalty.
I personally think of it as a penalty, but I don't know what other people think.
Okay. So what other kind of companies are affected by this? I guess you talked about Home Depot, UPS, and Coca-Cola. Those are the Atlanta companies. Mm-hmm. Is every single company that does business internationally going to be affected by this, especially if they're investing money outside the United States?
Yes, because most large companies will generally take advantage of the tax loopholes, as we would like to call them, on reinvesting their money offshores. So I will say a lot of the clients that I've worked with, all of them have reinvested a portion of their earnings offshores, and so they are definitely subject to transition tax.
Okay, so are there any positive effects of this new tax law? Is there any positives?
There are definitely positives for people like me, because it's more challenging. It's definitely something to learn, and it's just a really really interesting time to be in it because now the planning structures and the planning ideas are completely different.
Yeah, well, it's definitely a positive for attorneys. Almost all transactional attorneys are swept up in the new tax law. I mean, my client that I'm working with right now, the whole thing is basically preparing them for the new tax season, and that's just assets. So it's crazy. I don't know if it's just the new tax reform is just feeding the pockets of attorneys.
I think it does, but hey, I didn't make the rules, so I didn't do it.
Yeah. Okay. So what are we talking about with new tax regimes here?
So there are going to be quite a few different acronyms. There's something called GILTI, which is Global Intangible Low Tax Income, and we touched upon this earlier because this is subjecting U.S. companies to U.S. taxes on their foreign subsidiary earnings. There's something else that is called the Foreign Derived Intangible Income Deduction, which is something new. It's actually giving a benefit for providing services.
Well,
or
that's what I was looking
products
for, some kind
offshore.
of benefits there.
It is a benefit, but it could be repealed any moment. So that is something to be determined, honestly.
Okay, so get into that a little bit. What are we talking about here with the foreign derived intangible tax
So
income?
it is talking about if you are providing services or you're selling goods to a foreign person. And so that particular income, you are subject to a deduction on your taxes. And so that is one type of income, but you also have to weigh that against the GILTI, which is going to be a new tax on your income offshores.
Okay, so you're listening to Lewis on the Law. I am here each and every single week, and this show is designed to bring you information. It's legal information, not to replace the advice of an attorney. If you have a serious legal issue, go ahead and contract with an attorney. I'm here in the studio with attorney Lucy Zhang, and we're talking international tax law. I got a lot of other great stuff coming up for you, including planning, strategies, different takes on it. We'll be back in just a minute. You are listening to Lewis on the Law. My name is James Lewis, and I am your host this week and every week for an exciting foray into the world of law. That's right, the law can be exciting, and it's exciting when you listen to it here on this station. I have attorney Lucy Zhang in the studio with me, and we have an awesome show going. We're talking about international tax law. Now, if you need to get in touch with me, if you have a legal issue, I might be able to help you with it. You can contact me at jameslewislegal.com. You can email me at james@jameslewislegal, or you can give me a call at 404-610-0075. If I can't help you with your legal issue, I can direct you to an attorney who can help you with your legal issue. All my shows are archived on my website, so you can go back and look through, and you don't even have to contact me. If you see your issue there, hopefully one day we'll have each and every single legal issue archived, and you'll just be able to go there and touch on it and get at least a basis of what you're looking for in an attorney, what you're looking for in your legal issue, what you need, what type of things you need to preserve, what type of things you need to be looking forward to. Now, Lucy, you threw a whole bunch of acronyms and letters at me. It's like, reminds me of my beginning days at law school. I'm like, look at all these words. What do they mean? So let's get back into that. I mean, GILTI, FDII, run through those real quickly and kind of break them down for me.
It's like alphabet soup, right?
Yeah, it is. It literally is.
So with GILTI, it's called the Global Intangible Low Taxed Income. So don't let the name fool you because it's not just relating to intangible income. It's
now is this something for the guilty? I mean, it's like guilty. I am guilty because I've been caught with my hands in the cookie jar. Is that an acronym they kind of threw in there just to make companies feel really bad about double dipping in the international candy well?
I would think so because think about transition tax as a penalty. GILTI is basically another penalty for those who are guilty of benefiting themselves of the different tax regimes. So think about it that way. And it's really interesting because we mentioned earlier about the worldwide tax system and how a U.S. parent corporation is subject to tax on its foreign subsidiary income. And because of the change in tax reform, Congress said that they're doing away with that. But this GILTI is taxing the U.S. parent corporation similar to what it would have done in the previous tax regime, which is really, which is makes it really interesting in what Congress is really trying to do and what their intent is behind this,
Hmm.
because it's still taxing U.S. corporations on their foreign earnings and their subsidiaries. So you got to keep that in mind that although there is a dividend a deduction, it's still subject to foreign taxation. And that's definitely something that companies should keep in mind when they're creating new subsidiaries offshores.
Okay, so it is a penalty for the guilty, and that's a great way to remember it. So now FDII, get into that a little bit.
So FDII is supposed to be a benefit. This is the one good thing I think came out of the tax reform. It is actually supposed to encourage U.S. corporations on providing services and goods to foreign non-U.S. individuals. And with those income, you are actually getting a tax benefit. The one thing about this is you just have to remember that guilty is calculated by what your foreign earnings are, and there are so many different pieces of that particular calculation that you also consider what type of qualified business asset investments you have. And this qualified business asset investment is I will actually refer to as QBI because that is quite a mouthful for anyone to say.
I mean that gets me thinking right there. What is a qualified business asset?
So that will be a tangible property used to generate income.
Oh,
So
this
just
is
like
actually I'm actually doing for a living right now.
yeah, like property, like what people call PP&E, so property, plant, and equipment. So those are the types of QBI that you would consider for a guilty, and that is also something that you'll consider in FDII, the foreign derived intangible income. And so with FDI calculation, you have to consider, well, how much domestic QBI do you have? And then you use that particular information to figure out, well, this is my guilty, and then this is my FDII. So there's that additional taxes that you need to pay on for your foreign income, but then you're also allowed a certain domestic deduction. And so those are just numbers that you can play with. So for those who actually do like numbers, this will be a fun exercise for you.
Okay, I don't know about fun exercise. Now, so to me, it sounds like FDII is basically a trade export incentive.
Yes, that would be a good way to think about it. And it is one way to incentivize U.S. corporations to continue to conduct business offshores. But at the same time, you have to keep in mind that it may be repealed any day since most foreign countries are not so happy or keen about this because it's giving the U.S. corporation an unfair advantage compared to other foreign companies. So there are some interesting reading and court cases with the WTO, the World Trade Organization. So it's to be determined if FDII will be here to stay.
Okay, so wait a minute. So I mean, it gives the U.S. corporations an advantage because they can charge lower prices because they're not subjected to this, or they have a tax incentive in this case. Now, does it work as an actual tax incentive where they're getting money back, or is it work just to reduce their taxes?
It's generally used to reduce your taxes because the rate is lower than what your tax rate would be. But you have to also keep in mind that even though there's this one benefit, there's guilty where you have to pay additional taxes, and there's something called the BEAT, which is called the base erosion anti-avoidance tax.
Okay, the BEAT, the base erosion anti-avoidance tax. That's
Yes.
that's a huge mouthful. So you're going to have to break that down a little bit for us here.
So for those who are familiar with the alternative minimum tax, it is a method that you in the previous tax regime, you would calculate, well, what is the minimum amount of tax that a company should pay on their income? And if your actual income minus your reductions and your deductions, it's actually lower than this alternative minimum tax, you're subject to paying that alternative minimum tax amount. So BEAT is similar to that idea. It's a minimum tax to prevent U.S. taxpayers from benefiting from their tax planning strategies. So again, we had the guilty.
Wait a minute. They want to stop us from benefiting from our tax planning strategies?
Well, I mean, of course, you got to bring some taxes back, right? There is a large deficit.
Wait a minute. I should be rewarded for having a strategy in tax planning in the first place. I mean, I'm handicapped.
So that's why it's saying, well, there is the FDII benefit, but then at the same time, there are all these different things that are basically penalizing, in my mind, in my opinion, on companies who want to conduct business offshores. So yes, there is this incentive to increase trade and trade exports, but at the same time, you have to keep in mind they're still subject to guilty inclusion taxes. And then maybe if you are able to decrease your taxes to a specific type of minimum, BEAT will always come back and haunt you.
Okay, so beat will always come back and haunt you. So you're beating the guilty, right?
I wish you can beat the guilty, because at that point you have beat and guilty.
Oh, okay. Wow, that's a whole lot to get through here. Okay, so now we're talking. Now you kind of got into strategies here. So what does that leave people who do this type of tax planning and strategy? What does that leave them? Because predictability for the future is one of the things that you have to run a business.
So James, now I get to test you and challenge you with your math skills.
Lord, oh God! I'm one of those people who went to law school because my math skills were lacking.
Yeah, that's basically most people in law school.
I mean, interest rates are almost at the extent of what I do these days.
Well, funny thing that you say.
And I use an interest calculator too. I'm just like, what? I don't understand this. I'll just put the numbers in the calculator and it spits out a number for me.
Hey, I do too. There's something called Google, which is really useful for those types of calculations. But funny thing is, you mentioned interest rates. That's actually definitely something that companies will consider when they're making their tax strategy planning. So one way to take advantage of it is using related parties and related companies. One related company A will loan money to related company B. So A will actually earn interest income, where company B will actually be able to deduct interest expenses. So one fun way for companies, I guess fun would be a bad way to say it.
Well, you've made this whole thing fun and exciting. I mean, you guys should have gotten it. When I had lunch with Lucy the other day, she's like, it's an exciting time to be a tax attorney. You should go back into tax law. I'm like, yeah, I don't know about that. It's been several years removed for me now.
But yeah, you can actually take advantage of the net arbitrage of tax rates. So if your U.S. tax rate is 21%, and your German tax rate is around 33%. If you get an income if you are able to get a U.S. income at that 21% rate, and then you get a deduction for the same amount of interest within those related parties at 33%, that's around what? You can do the math. It's really simple. It's a 10% difference.
Does anyone have a calculator? You guys have a calculator? Okay, you are listening to Lewis on the Law. We're going to get back into planning and strategy when we come back. This show comes to you every single week, and once again, my show is not designed to replace the advice of an attorney. If you have a serious legal issue, go ahead and contact an attorney. Don't take the advice or the information you hear on this show and say, yeah, I'm about to go into court with my tax issues, or go to the IRS tax court, which is even worse than the court. I am here in the studio with attorney Lucy Zhang. We are talking international tax law. You can get in touch with me at jameslewislegal.com. You can go ahead and check out any of my old archive shows. You can go ahead and listen to them. Eventually, we'll get the videos up on them. All kinds of things will go on. There'll be a huge archive database of legal issues for you to draw from. When we get back, we are going to talk planning strategies for all those companies that need to know, because I am one of those people who just need to know. You're listening to Lewis on the Law. My name is James Lewis. We'll be back in a minute. You are listening to Lewis on the Law. My name is James Lewis, and we are into our final segment. We have a great show going for you guys today. It's on international tax law and talk about a complicated subject. I had Brian Sengson on not too long ago from Bennett Thrasher, and who we were talking local, state and local tax. And I was like, you know what? I'm following this exactly. I still got it. Now I bring you on my show, and I'm just like, you know what? I don't have it at all. It's been so long since I was doing anything with tax law that I'm like, offer and compromise. That's about as far as I go.
You're not the only one, because all of us, we're confused too, because we're still waiting on regulations and guidance. So you're not the only one, if that makes you feel a little better.
It does make me feel a little bit better. I'm just like, wow, okay, tax laws really bypassed me these days. So let's take this all the way back from the beginning. Let's go ahead and kind of work through this process and kind of summarize it and get this last segment to something of a nutshell for listeners to go through. So we're talking pre-tax reform. So what do we need to know about international tax law pre-tax reform?
So pre-tax reform, a lot of companies will generally utilize the benefit of reinvesting their foreign earnings offshore. So those earnings are not subject to a U.S. tax. So that just decrease their tax expenses. That is something to keep in mind, because all of those earnings from 1986 to 2017 is now subject to that one-time transition tax under the new tax reform regime. And so that is definitely something that the new regime is impacting most companies on. But you also have to remember that that is not the only thing that the new tax reform is subjecting these companies to. There are quite a few different terminologies that everyone needs to know. Like I called it before, alphabet soup. There are different things such as GILTI, which is another type of taxation on their foreign subsidiaries. And while at the same time, there is a type of it's similar to what it was back in the day before tax reform, but at a lower tax rate, which is going along the lines of the change in the tax reform. Another thing that companies should keep in mind is the foreign derived intangible income, which is the FDII, which is a good benefit for bringing services and exporting things offshores to foreign companies, for countries. But that's just something else that companies will need to think about. So, James, what do you think? Would you want to move offshores, expand internationally now?
You know what? I actually think that there's probably still a lot of benefit in expanding internationally, especially if I have that kind of money. So the answer is yes, but I'm actually more intrigued about bringing investors into the United States, because it seems like that's where more of the benefits in our new tax regime lie.
I would actually agree with that, especially since a lot of companies are now thinking of bringing back their QBI, which we touched upon earlier, which is the Qualified Business Asset Investments. And because of bringing that QBI back into the U.S., you're able to get more of the FDII benefit, which is a tax benefit. So there are things that you are able to actually take advantage of in the tax regime. Especially since there are definitely different ways that tax reform and Congress are trying to penalize, how you said, penalize the guilty by.
I actually like that. I like penalize. I like guilty, and I like beat, because it's kind of, you penalize the guilty.
Exactly. And so beat is definitely something people need to keep remembering, because it's the base erosion anti-abuse tax. It's just subjecting different companies to calculate what their tax payments should have been, and if it's higher than what they're thinking that they need to pay, then they need to pay what is
So you're beating the companies. You're actually beating the guilty.
Yeah, maybe you should use that phrase instead.
I think I just did.
Well, you have to keep using it.
Okay, sounds great. So we've gone through pre-tax reform. We've talked on the post-tax reform, and you've talked a little bit about the new tax regimes. Is there anything we need to go through in just to catch us up before we get into planning and strategy?
No, those are definitely things that everyone should think about, especially guilty, the beat, and FDII. And the most important things is, if you are able to break down this code statutes, maybe this will be good exercise for us later to do with your math skills and your calculator. There are different
My handy calculator, yeah, right.
There are different parts of the equation for guilty and FDII that are interchangeable. So if you change one piece in FDII, guilty will change. So it's just a really fun exercise with numbers, and then you get to see what is the impact based on a change, one small change.
Fun exercise with numbers. That is probably not what I'd call that. But anyways, since you're having this fun exercise with numbers, let's talk a little bit about forecasting. With so many moving parts, how does this work?
The best way to do it is dissecting the code and regulations if they're available. One way is we actually created, my company and I actually created a different type of
Can you
Excel.
say your company name on air?
Yes, I work for Ernst & Young, and so I've done quite a few modeling exercises for a few clients. The best way to think about it is think Excel sheet. It might be really simple and easy, but think maybe 20 to 30 different tabs with different calculations and different inputs. The way we would think about it is looking at a company's tax returns. And by dissecting the code sections, we will use their tax returns and put it as an input source data, and then use the Excel to make our model. We'll add different types of formulas, and we will add the different types of deduction percentage rates, the different types of tax rates that the tax code gives us, and that's how we were able to create a model. So just as an example of FDII and how we calculate it, FDII is based on the foreign income, the income that the U.S. company is making off of sales of goods to non-U.S. individuals or services provided to non-U.S. individuals. That's one component of the calculation. The second component is just the overall income of this particular company. You times that particular ratio.
Wait a minute. Overall income, you're talking about income not only derived from foreign individuals, but also overall income here domestically?
Yes.
Okay.
Exactly. And then that particular ratio, you multiply it by that, the overall domestic income times 10% of your QBI, which again is the qualified business asset investment. So those are, let's say, maybe 4 different types of moving factors that we would look at. We would pull those numbers off a company client's tax returns, and we would plug it into this calculation. But at the same time as we're calculating FDII, we will use the tax return to calculate GILTI. And what I think is the most entertaining part of this is once you have a specific base case of seeing what GILTI will do and impact this particular client, you can play around with the numbers and see, well, hey, what if I move some of my business assets from foreign back to the U.S.? And what if I actually decided to increase my sales to non-U.S. individuals? What will that do to my FDII? How will that affect my GILTI? And so it's just like
now, let me ask you a question on this. Now, when you're talking about moving foreign business assets back into the United States, you're not talking about property assets.
You are.
Okay.
This is going to be moving back the QBI, the qualified business asset investments. That is the tangible property that you are using to generate income. So that is definitely something that maybe your clients might be interested in doing, since you mentioned bringing them back domestically.
Yeah. Now, okay, so we're getting towards the end of our segment, so I want to wrap a couple of things up here. So we're talking, are there incentives for people who are bringing investments into the United States here in this tax law?
Yes, there is. There's ways to benefit themselves by using the FDII, bringing back the business assets into the U.S. to help them benefit because that generates the deduction eligible income for when they are using those resources to provide services or goods to non-U.S. individuals.
Okay, so is this new tax law spelling the death of moving businesses offshore?
No.
No.
Businesses are still able to do so. There are definitely plenty of ways that businesses can be inventive on benefiting themselves on different tax regimes. It's not just the U.S. tax law in play. It's all the other local country tax regimes as well.
Okay. Well, it's been a great show, Lucy. We've gone through a lot of stuff for me to redigest and go back through. You're listening to Lewis on the Law. I've been on air with attorney Lucy Zhang. We've been talking about international tax law, and I've known Lucy for 6 or 7 years now, and this is the first time she's ever told me that I'm pronouncing her last name wrong. I'm just like, okay, that is way too nice to go about it. You need to tell people, well, it's actually not that way. You're listening to Lewis on the Law. I'll be back next week with another great show for you guys, and I think we're talking about injuries next week, personal injuries.